Hello, Jim here. I believe that selling options is a great way to make some extra income, but you can definitely take way too much risk and blow up your account. Today, I want to talk about a few things you can do to protect yourself. I've had a number of calls from, or not calls, messages from both subscribers and members that have found themselves kind of in a bad way with a particular trade. So, I'm going to talk about some different scenarios, some things you can do, and just a way to stay safer. So let's go ahead and jump right in. Now, I've got a list here of the key points, and my hope is that people will start a conversation. So please leave a comment if you agree with me, disagree with me. I typically answer all my comments below. And as always, please subscribe, hit that like button. Details will be in the description about my memberships if you're curious about them. But let's jump right in. I want to kind of get into these and talk briefly about them at the next part of the video. And I'm trying to keep this video a lot shorter. I'm going to share with you kind of what it looks like when you start taking too much risk. But first of all, I believe a lot of people, the first big mistake they make is picking the wrong company. And it's not necessarily what you think. I personally will not mess with a company that's not making earnings. So I may add them to my watch list, but until they're making earnings, it's not a company I will trade in typically. I also will look at pricing. I've been burned before by very expensive companies that have gone through the roof. I have an older video where I got burned by Microsoft. And so I stay away from these really high flying stocks. I stay away from Nvidia, Microsoft, Netflix, companies like that because they can move 20, 30, 40, 50 points in a day. And I just find it too risky. So I typically will stick with less pricey companies. I try to keep it under maybe 150. On occasion, I will go a little bit higher, but I try to keep the stock price lower. Another important piece is, I prefer companies that have no debt. If I can find a company that has no debt, it's a trade I'll make. A lot of people have questioned why are you looking at Palantir? And some of the companies I look at, like Zoom, well, both Palantir and Zoom have no debt and they have good profits and are growing. So the fact that they're able to do that without any debt is just amazing to me. And any company that can do it typically has got a bright future ahead of them. I also like to look at year over year earnings. Are they growing? Are they growing fairly nicely? And I also like to compare their PE, what their PE is compared to the industry. Are they way overpriced? And sometimes I will find a lot of companies that are overpriced. I prefer to stick with companies that are bargains. And in this market currently, a lot of stocks are way overpriced in my mind. You might disagree. One example is Nvidia. I believe Nvidia is way too pricey. And so I won't look at doing a trade with Nvidia. Now, I did a trade actually last week with Nvidia, but I have 20 shares. I sold 5 shares because I felt like it was at such a high price. I wanted to trim my 20 shares. So I sold 5 and I still have 15. I really played with the idea of selling all of them at this price because it's gone through the roof. Another important part, or with trading options, is diversification. Now, it's kind of a nice balance. You don't want to be too undiversified. You don't want to always be trading in the same one or two stocks. I've noticed a lot of other YouTubers will be trading in just a few names, and I feel that's too risky, especially if you're doing multiple trades on the same stock, unless you've got plenty of cash and want to own that stock and want to own quite a bit of it. And I think you can also go too far the other way. You can have way too much diversification. And I started that way. Now I choose, I used to have close to 100 stocks I would look at and quite a few ETFs. Now I've got like 8 to 10 ETFs on my watch list. I actually have more, but I typically primarily have between 5 and 10. And in stocks, I maybe have close to 25 that I like. And I typically will look at companies that are bargains. If their PE is way higher than everyone else in their industry, then I typically avoid them. Or if they've recently been hurt by earnings, then I might look at picking them up and maybe selling a cash secured put or a vertical put credit spread on them. One example is 3M. I recently did a a cash secured put on 3M, which got hammered last week, or might have been 2 weeks, but just got hammered with earnings. And, I think 3M's a wonderful company long term. They had some legal issues that they've worked through recently, but, once the price gets to a certain level, to me, it's well worth it when you look at the dividend and, what you can earn, not just by selling options on it, but then also dividends. So again, diversification, it needs to be somewhere in the middle. I'd like to have a rule of thumb of no more than maybe 5% of your total account in any particular stock. Now, an ETF may be different because the fact that they have multiple holdings, you can go a bit higher than 5%. But individual stocks, try to keep it under 5% or no more than 5%. And then the other big issue I've seen is people taking way too much risk with the number of contracts. I started with one contract till I learned the right way to actually sell puts and vertical put credit spreads. Then I went to two, and on occasion I'll do three or four. Like Palantir is pretty cheap, so I'll do 4 contracts with it at times. But I've seen other YouTubers and members and subscribers do 10, 20, 30 contracts. And there are some professional traders that are doing that many contracts, but just by increasing the number of contracts massively increases the risk you take. And then a lot of people will not have the funds to cover their positions. I typically have enough funds in my accounts to cover my positions. To me, it's not get rich quick. It's adding a couple extra percents. Maybe instead of having a 8% return, you're able to get a 14 or 16% return. It's not, I have a lot of new members that will share that they want to do 5% a month, 10% a month. And that's potentially doable, but you've got to take so much risk, and the chance of you blowing up your account is quite high. So my encouragement, especially if you're a new options developer, start with one, then you can potentially move to two. And then as you get to become more of a seasoned trader, increase that. And again, at the end of this, I'm going to share with you what that looks like and why a lot of people get drawn into that. They feel like they can make a ton of money very quickly. And then another important point is it's really, really risky to let your options cross over expiration. Now, it's one thing if they're way out of the money, but if they're near the money or in the money, you typically do not want them to cross over expiration. I typically like to tell my members to look at trading that or rolling that position or closing that position at least 2 days before expiration. One thing a lot of people are not aware of is the way the trading works, especially, and I believe it's every day of the market. The market may close at 4 o'clock, but someone has another hour and a half after closing to do an assignment. So if, I bought a put or I bought a call, and maybe the market closed and that particular stock was not in the money, so at that time I did not want to own those shares or put those shares to someone else. But in that hour and a half after the market closes, if some bad news comes out, I can still make that decision up to an hour and a half after the market closes to put those shares to someone else or to call those shares away from someone else. So just be aware of that. It's a way to avoid that is, again, don't let your positions cross over expiration. Always try to close them or roll them a couple days before. And that's especially true if you're very near the money. If you're way outside the money, it's less of a concern. If you're in the money, you definitely need to be doing something else. And this relates to the next key point, is managing your trades. I've got a management worksheet that I provide to my membership, and usually 3 to 4 weeks, I will put any trades that are expiring in the next couple of weeks. Like right now, it has all my different trades. I believe I have 8 trades that are expiring on February 16th. So my spreadsheet currently has all 8 of those. All 8 are outside the money. And surprisingly, all but 2 are similar trades. And I believe those 2 relate to one another. So I had done a poor man's covered call a while back. So two of those eight relate to Palantir in that poor man's covered call. Everything else is different positions, different stocks. So I kind of wanted to add that, and primarily because I've gotten, again, many messages, both from subscribers and members, that find themselves in a tough way. Keeping these ideas kind of in your mind, you'll be able to stay safer. So now let's jump into the next part of the video, and I'll share with you what it looks like and why people get drawn into taking a lot more risk. Okay, now I've opened up my Schwab account to another stock that I like, UiPath, which is the ticker symbol is PATH. And I'm going to go out a little bit farther than I typically do, just to show you how the numbers can have a big impact. So I'm sharing with you May 17th. It's 110 days. I typically recently trying to keep my DTEs under 90 days. But you can get a feel for it. The other thing I forgot to mention at the beginning was also considering delta, taking a much lower delta, taking less risk makes a lot of sense. So here you can see it's currently at 2274. A 16 delta is less risky than a 20 delta, and a 20 delta is less risky than a 26 delta. And for an account that I have that's mostly invested, that I'm just potentially want to own another stock or two, I usually will take a little bit less risk. Now, if it was the wheel and I literally, and in my Fidelity IRA, I don't have much, I think the only investment I have is Corning, then I would potentially take more risk. So I might look at the 20 delta versus the 16 delta in that scenario. But you can see that the amount, the 90 versus 66, is a fair amount. And being that it's fairly inexpensive, by default, you would probably go with a cash secured put than a vertical put credit spread. But that's another gotcha. That's another area that you could potentially get yourself in trouble. So let's jump over here, and I've got path brought up, and I'm just going to switch this to puts, and I'm going to just say sell to open. I'm going to go out to what I was just looking at, which is May 17th, and I believe it was $18. Let's look over here. $18 was the 16 delta. So we'll take a little bit more risk. We'll go with 19, which is a 20 delta, and we'll switch this to $19. So you can see it's 90.92. So I would potentially get between 90 cents and 93 cents. Now, to me, an extra, 3 cents is $3. So $3 more in this trade, it doesn't make a whole lot of sense for me. So I would probably do market, and I'm almost assured to get this $90. Now, the market's currently closed. This is Sunday. So I could pick up $90 for a $1,900 investment. And of course, this is going out almost 110 days, but it's still a pretty good return. Now, what a lot of people will do, well, I like that $90. I'm going to do 10 contracts, and suddenly I'm picking up $900, and they get the feeling that, this will probably expire outside the money. Me, I would want to own path, so I would never do 10 contracts, because that's, what would that be, 1,000 shares? And even at 1,000 shares, you're still talking $19,000. And depending on your size of your account, that is definitely above the 5% I was talking about earlier. So I would never go to that high. Plus, I would not have enough cash to handle that. So I typically always start with one. So, going up, just because you see you could potentially make a lot more money. Now, another thing you could do to reduce your risk is switch it to a vertical put. So the same kind of trade, 517, again, $19, and buy to open, I would, you could do something like 17, which is a $2 spread. So you're putting around $200 minus $36 at risk to pick up $36. Now, I typically like to go out $10. So I would look at, well, let's say a $9. Well, and that, you'll find this too. Sometimes for some reason, the ask for the put will be through the roof. I don't know why. A lot of times it's, if you change that, you'll find a much better one. So this is 73 cents for a $9 spread. And then I'll play around. Like I may go and see, well, can I do 11? Wow, that dropped. So actually going to 11, which is a thinner spread, brought in more money. Let's play around a little bit more. What would 12 bring in? Almost the same amount, so 7 cents. Let's go to 13. So I'm down to 75, but it's still relatively cheap, but it did jump up quite a bit. So let's go back to 12. So this would be a $7 spread. I'd bring in $83. And typically I like $10 for every dollar spread. So if I got 70, I would be happy with this. But the fact that it's 83, it turns out it's a good trade. Now, what would happen is people would say, well, I'm only taking $7 of risk. And they again would go way back up and do lots and lots of contracts. I've seen scenarios where members have shared with me where they've had 20 contracts, where you can make a lot of money, but again, it'll blow up your account if something happens and, the value drops massively because a market correction or earnings or something else comes out about the company. You could find yourself kind of in a deep hole. So that's why I suggest typically don't do a whole lot of contracts. I don't know why it'll go up with you, but now it's going down. So I typically will start with one when it's this inexpensive and I have a small spread. I might go up to, I typically will go up to two. Most of my trades, if you're a member, you already know this, are two. With it being fairly inexpensive, the 19, I might do three and bring in a little bit more. But I definitely would not be going higher and higher and higher. But this is definitely less risky. And I always encourage people, to buy the put for the protection on the downside, especially if it's this cheap, only $7. It makes a lot of sense to buy it. And then, once you've actually reviewed the order and you made the order. Now, if we do a market, let's make sure, 249. So just wanted to be sure it was giving me accurate information. Then again, the main reason I do market trades is I don't want to be on the market all day. I want to make my trade. I want to get off. And then I will start managing this, and I'll add it to let me just bring up. So here's my planning worksheet for this week. And these are all the different trades that I have that are expiring in February. And so early May, I would probably add it to my planning worksheet, but I review this on a daily basis. Here you can see I've made so far for January over 6,000. So I'm close to my 6,400 that I'm trying to make. And this is a short week for January. I believe Monday, Tuesday, Wednesday, and the beginning of February is Thursday. So, and the only one I'm really worried about here is Polaris. So the one I'm probably going to need to manage, and I don't want to let it expire, or crossover expiration, is this Palantir, because it's fairly close to the money. It's currently 92 and it's 90. This is a covered call. The Palantir is pretty far outside the money. I won't go into these. I just wanted to share with you. I use this all week. I will keep this spreadsheet up with me and I'll make my trade and get off. But that's what I wanted to show you. I wanted to show you there were steps you can take to protect yourself. And again, try to limit the amount of risk you're taking, because with the market and with trading and with investments, it's kind of like the unexpected is what to expect. It's, I thought the market would have had a downturn over the last couple of weeks. It went up, and the exact opposite could happen if the Fed makes a negative comment this coming up week. They meet tomorrow and Tuesday, I believe, maybe even Wednesday. If they make some comments about increasing rates or even surprise us with an increase, then the market would go down significantly. I don't think they're going to do that. I think they're going to keep rates higher for longer. But again, you never know. They could change that quickly. So that's what I wanted to share. Please leave comments. Let me know if you have any, if you agree, don't agree, and look forward to seeing you next time. Thanks for joining me.